NVIDIA Corporation closed its latest regular trading session on Friday, July 17, 2026, at 4 p.m. Eastern Time at an exact price of $202.81 per share, marking a noticeable downward movement of minus 2.21% as it shed $4.59 throughout a highly volatile day. While the headline numbers indicate a standard summer tech cooling off, the real anomaly right now lies in the dark pools, where institutional block orders are quietly shifting away from speculative positioning and heavily accumulating massive derivative hedges, suggesting that large-scale capital is preparing for a macroeconomic shift that retail investors are completely ignoring. The widespread expectation among retail traders is that NVIDIA stock will endlessly march upward because its hardware underpins the modern computing infrastructure, making it a permanent safe haven for anyone trying to build a self-investing strategy. The reality, however, is that while the underlying business remains incredibly profitable, the stock has essentially turned into a massive liquidity sponge that reacts more to macro policy changes, sovereign tier export updates, and global bond yields than to its actual architectural updates, exposing casual buyers to significant short-term downside if they treat it like a traditional tech company. Looking closely at the recent stock movement, the intraday action on Friday saw the price fluctuate between an opening mark of $202.64, hitting a brief high of $206.645 before plunging to a session low of $197.97 on an incredibly heavy trading volume of over 144 million shares. This intense volume indicates a deep battleground between retail accounts buying the dip on popular online investing platforms like the Robinhood app and massive institutional wealth desks shuffling capital inside their individual brokerage accounts. For those managing a personal individual brokerage, keeping track of these microstructures is vital because NVIDIA stock has suddenly found itself vulnerable to broader sector rotations. Over the past few weeks, we have watched technology indices experience significant profit-taking, driven largely by rising government bond yields, which naturally lower the present value of future corporate earnings. This volatility has caused many individuals who manage their own self-investing portfolios to wonder whether the broader momentum is cooling down or if this is simply a healthy consolidation period. When you look at contemporary trading venues like the Interactive Brokers platform or check your asset allocations inside specialized accounts like Schwab Intelligent Portfolios, the data shows that institutional options flow for NVIDIA has seen an unprecedented spike in out-of-the-money put options. This indicates that while the public narrative focuses entirely on next-generation hardware shipments, the professional asset managers using advanced Interactive Brokers trading tools are protecting their gains against an unexpected drop. The dynamic between expectation and reality is clear here because the market expects an uninterrupted line of record-breaking revenue, but the reality of institutional positioning shows a distinct caution. Many investors look at the general strength of mega-cap assets like Apple stock or the enterprise cloud tailwinds behind Tesla stock and assume everything in the tech sector will move in tandem, but the hardware level is facing unique geopolitical friction. Comment below how many shares of NVIDIA stock you currently hold in your portfolio and whether you are buying more at this current level or waiting for a deeper correction. Understanding this balance requires evaluating the core macroeconomic drivers that shaped the recent trading sessions. Just a week ago, the stock experienced a sharp 4% jump following an official policy announcement from the United States Commerce Department, which reclassified the United Arab Emirates into a higher trust tier export tier. This regulatory shift effectively allows sovereign tech firms in the Gulf region to purchase advanced processors without undergoing the lengthy line-by-line shipment reviews that previously restricted international sales. The immediate market expectation was that this would cause an absolute surge in immediate revenue, but the reality is that a regulatory door opening is not the same thing as a signed purchase order. Professional traders executing strategies via high-volume tools like interactive brokers stock trading quickly realized that this policy change also benefits direct competitors, meaning the long-term market share split in the Middle East is still very much up for grabs. To properly contextualize the stock, we have to look at what the business actually does underneath all the market noise. NVIDIA operates primarily as a fabless semiconductor company that specializes in designing advanced graphics processing units, tensor core processors, and a highly proprietary software stack known as CUDA. Its core business model relies on maintaining a massive technological lead in architectural design while outsourcing the capital-intensive manufacturing process to specialized external foundries. This approach allows the company to maintain exceptionally high gross margins, which recently helped it report a stunning fiscal performance, with total annual revenue climbing to $215.9 billion. Over 90% of this massive financial inflow is generated directly from its data center segment, highlighting just how heavily dependent the firm has become on a small handful of hyperscale cloud providers who are building out server infrastructure at a breakneck pace. Historically, the company built its foundation on consumer graphics cards for PC gaming and digital asset visualization tools, but its strategic pivot towards parallel processing hardware laid the groundwork for its current dominance. For years, investors viewed the stock through the lens of cyclical consumer hardware cycles, which explains why older financial reports showed dramatic revenue swings tied to consumer spending habits and digital asset mining trends. However, the creation of the CUDA software layer completely altered that dynamic, locking developers into their proprietary hardware ecosystem because software built for their architecture cannot easily run on rival chips. This historical software moat is precisely why retail platforms like the SoFi Invest platform, active accounts on Robinhood stock trading, or professional setups like the interactive brokers platform continue to see massive inflows from retail buyers who believe the company has no viable long-term competition. Yet when we look at the future outlook, the tension between what the public expects and what reality might deliver is widening significantly. The bull case heavily relies on the successful rollout of the new Blackwell chip architecture and the upcoming Rubin platform, which are projected to ship in millions of units to major enterprise clients over the next 12 months. Optimistic Wall Street analysts tracking these supply chains have issued price targets as high as $330, suggesting a major upside from current levels. But if you look at the actual operational risks, minor production delays or supply chain bottlenecks could easily disrupt this timeline, causing hyperscale clients to reconsider the pace of their capital expenditures. Furthermore, the threat of stricter trade restrictions between major global economies remains a constant drag on long-term supply chain stability, meaning that access to raw materials and international markets could change overnight. For anyone building a modern individual brokerage account or adjusting their long-term holdings within digital systems like Schwab Intelligent Portfolios or a specialized intelligent portfolio structure, managing this specific type of concentration risk is critical. Relying too heavily on a single hardware provider can expose a portfolio to massive swings, which is why many conservative wealth advisors suggest balancing tech exposure with broader market instruments. Those looking for alternative ways to manage their capital often look into diversified packages, such as utilizing the Fidelity mobile app to research targeted sector funds, exploring customized options via Fidelity Wealth Management, or allocating capital across specific Fidelity IRAs to mitigate direct equity volatility. Diversified approaches like utilizing Fidelity investments, building a base with low-cost Fidelity ETFs, or anchoring a portfolio with established Fidelity mutual funds can provide a necessary buffer when high-flying individual equities experience sudden double-digit pullbacks. Ultimately, the market narrative surrounding NVIDIA stock is locked in a fierce battle between long-term structural dominance and short-term valuation fatigue. While the absolute scale of enterprise demand for processing power is undeniable, the current stock price demands perfection across every single product launch, earnings report, and global policy update. Investors who use platforms like the SoFi trading platform, active accounts on Robinhood stock trading, or professional setups like the Interactive Brokers platform must distinguish between the operational brilliance of the underlying company and the technical vulnerabilities of its shares. The key to navigating this stock moving forward lies in watching institutional